Hello, everyone. My name is Daharsh, and my colleague Larissa Greene and I are here today to bring you a great webinar on seller financing, an in-depth look for real estate investors. So we're here to talk to you about seller financing, which is basically, in this context, in today's webinar, turning a real estate asset into a separate asset when you're ready to sell and move on from owning that property in your IRA or solo 401k. Again, today, this webinar is being brought to you by my colleague, Larissa Greene, who is our Director of Education and a fellow Business Development Specialist with Advanta IRA, and myself, Daharsh. I've been with Advanta since 2016. I've been a Business Development Specialist the past two and a half years now, bringing you tons of education and a lot of networking and great content to expand people's knowledge and understanding of self-directed investing. Larissa, thank you very much for joining me today on this webinar and putting this together with me. Thank you so much. And anything that you have to share with the audience as we get kicked off?
Yes, thank you so much, Corey, for having me. I'm very excited to discuss this topic. And really, this idea came from Corey talking about the different transactions that he used to assist clients with. So before he was part of the business development team, he was doing transactions as an account manager. And we were talking one day very specifically about a client who purchased a property, had it for several years, and decided they didn't really want to have to deal with tenants, toilets, and termites anymore, and wanted to sell the property and sold it on seller financing so that they could essentially still retain an asset in their account based on real estate and hold a first mortgage on that property. So basically just changing it, having some security on the investment itself, and really determining the rate at which their IRA is going to grow by setting the terms of the note. And so we're going to talk about that today in more detail. I've been with Advanta IRA since 2011. I started out doing back office work. I did some transactions like Corey. I also did check coding and accounting. I paid expenses on behalf of IRAs and received income. So I've sort of done a little bit of everything. And then about 9 years ago, I started in marketing, education, and business development. And I've been here ever since, and I've really enjoyed it. I've learned a lot myself so that I can put my own 401k to use and self-direct. And so that is what I do.
Awesome. Well, thank you, Larissa. And one final tidbit about our experience and education in this space that I'd like to add. We both have the CISP designation, as you might see on the screen right now. That does stand for Certified IRA Services Professional, and it pretty much means that we've both gone and taken a week-long course to learn all the ins and outs of what the IRS does and does not allow within these self-directed retirement accounts. And we also keep that designation by doing continuing education on an annual basis. So we are, if for lack of a better term, experts in what the IRS will or will not allow within your self-directed account. And again, that expertise is what we are here to bring you specifically. And segueing that directly here into our disclaimer, we do not provide tax, legal, or financial advice, and we do not endorse any specific product or investment opportunity that you may hear about. All of our information and materials that we're going to provide you today, including a few different case studies, are for educational purposes only. And we always implore you to consult your own CPAs, attorneys, tax professionals, legal professionals, and fiduciaries, if any, before you partake in any specific investments or investment strategies. Now, having said that, we do have a few takeaway points, and I'll reiterate these at the end of the webinar that I want to make sure hit home with everyone paying attention today. The first takeaway point is that you can actually take one asset and create multiple investments. For example, as Larissa mentioned, holding a piece of real estate and deciding you no longer want to be a real estate owner in your retirement account, but in turn, turning that around and being the lender to whoever you decide to sell that property to. So there's different ways and different asset classes that can utilize this strategy, but I'm just using real estate and lending in this specific takeaway point. As the seller and the lender, you dictate all the terms involved in this deal. So you pick who you want to sell the property to, as well as dictating all the terms of the loan that you are going to be the mortgage lender on. So the payback period, the interest rate, any specific increments or balloon payments that need to be made. That is completely between you and a negotiation between your buyer to determine, and you hold all that power and control. Advanta is not here in place to set any of those precedents. That's completely your discretion as the self-directed account holder. And the final takeaway point is that the IRA pays all expenses and receives all income related to the asset. So when it's a physical piece of property in your retirement account, all of the flow of money in and out goes directly through the retirement account. So there's no personal tax ramifications. It's all either tax deferred or tax free income that's flowing through the account, as well as when you transition the property into a loan, all of the loan payments come directly into your retirement account, not to your personal bank account or you personally, so that it can continue to hold the tax shelter that your retirement account is granted. Now, a little bit of background about Advanta IRA. We've been around for almost 20 years in the self-directed investment space. We've got just over $2 billion in assets under management. Our clients' funds are secured when they're uninvested up to FDIC insured limits. And all of our clients are paired with a dedicated client account manager. I served in that role for about 5 years before switching over to the business development team. I know Larissa spent some time in that role back in her earlier days with the company as well. But it's something that we prepare and provide for each client, along with these free educational components on our YouTube page and on our blog and via our podcast, where we try to stand above and beyond other competitors in the self-directed industry by giving you white glove concierge level service and also a ton of free education that you may be paying for with other custodians. Now, what is a self-directed IRA specifically? You may have a larger wirehouse custodian that claims they have a self-directed product for you, but when you look into it further, you're actually looking at a limited number of assets that they've already vetted out and given their fiduciary sign off, if you will, and let you choose from a list of 20, maybe 30 specific products on the market. But a truly self-directed IRA or solo 401k for that matter is an account where your custodian or administrator does not hold any regulations aside from the IRS's rules as to what you can and cannot invest into. You make all of those decisions. As long as we are helping you follow the IRS's rules and regulations, we do not have any further oversight into what you invest into or how you place your money. Some of the asset classes as displayed here include real estate, lending, which we're going to be covering specifically both of those points today, but you can also invest into private placements or syndications, precious metal, foreign currency, future trading, and many, many other asset classes. I know Larissa and I have a specific interest in some of the more unique assets that we've ever dealt with. They always kind of tickle our fancy, if you will. And we've got a separate webinar, I think we've done 2 years running now, on the most unique investments we've ever seen. So if you're interested in some other alternative asset investing, go ahead and check out our YouTube page and you can find that specific webinar on there to check out some really, really unique things. And again, put into perspective, if you have an expertise in investing and you know how to make money that some other people may not know how to, consider that you can probably do that through your retirement fund. Now, why do people choose to self-direct? Well, it kind of goes right into what I just mentioned, in that it's a new source of capital for people that are already investing in some way and realize that they can use this tax sheltered money to do further investments with a specific way they've learned how to make money or learned how to generate better interest than your typical stocks, bonds, and mutual funds. Referencing those stocks, bonds, and mutual funds, if you're someone that's looked at the stock market anytime lately, you notice that you're probably getting frustrated with the fluctuation or just the downturn in a lot of those different asset classes. So that's another reason that some people decide to start diversifying and switch, if not all, but some of their portfolio to a self-directed strategy. And then the tax benefit. Again, when you're doing real estate investing through a self-direct account, you're generating either tax deferred or tax-free income into your retirement account. When you go to sell a piece of property, that is not subject to capital gains tax and any other type of tax that may relate to that, because the investment is being taken down in the tax shelter of the retirement account, which is in itself a disregarded entity for tax purposes. Now, if you have not heard about self-directed investing until you're reviewing this webinar with us today, that's pretty common and it's to be expected. Not a lot of people know about self-directed investing, and that's why we're here providing education and networking in the communities of investors to try to bring awareness and attention. To be truthful, only about 4% of retirement accounts in the US are self-directed. And to put that into perspective, as of right now, there is close to 37 to 39, roughly 40 trillion with a T, dollars of money in IRAs and 401ks in the US. So not a lot of people know about it. We're here to expand education and awareness, but it is definitely a tool that anyone could take advantage of if you've got an IRA or you've got a former employer 401k that's able to be rolled over. It's just something that you may not know about, and hopefully we're here to educate you and bring a little bit more awareness, and if it fits your needs, give you the power to move forward with it. Now, there are a few asset classes that we want to hone in on a little bit further, just based on today's webinar and what we're covering today. So when we're talking about real estate assets, you can consider anything listed here. So single family homes, no matter what purpose you're holding that single family home for, as far as an income generating resource, condos, mobile home parks, or specific mobile homes. So you could join into a group holding a whole community, or even own the whole community outright in your retirement account, or own a specific unit or lot. Tax deed and lien investing is a great strategy for investors just getting started with their retirement fund that want to build from a smaller account balance into a larger property or a larger balance. And it's a great strategy that may even result in you holding a piece of property from a few $1,000s investment at your local tax deed and lien auction. Real estate investment trusts are pretty much used by a lot of group investors as well. And as I mentioned earlier, syndications or private placements, where you're just putting up money as a limited partner and you're letting the general partner team that you've vetted out and you've done your due diligence on do the day-to-day operations on the property and project. Now, paper assets that you can hold in your retirement account, we're going to cover mortgage loans today, specifically first position mortgage loans. But as I just referenced on the last slide with real estate assets, tax deeds and tax liens can be held in a retirement account. Unsecured notes or debenture notes, option contracts, assignments of other paper assets, joint venture agreements for real estate and other types of asset classes, and also accounts receivable can be held as a paper asset in your retirement account. Now, some other unique alternative assets that can be used for either collateral or completely different assets to be held in your retirement account that may not necessarily relate to our webinar today, but are also very unique and special classes that could relate if they are collateralized, is an LLC ownership, farm animals, partnership, ownership in a movie project, precious metals, as I referenced, equipment leasing, Forex or futures trading, private stocks, commodities, oil and gas. With that, I'm going to go ahead and turn it over to Larissa. She's going to cover some more information about some general details about retirement investing and actually jump right into our first case study as well.
Great, thank you so much, Corey. And just something that I realized we forgot to mention at the top of the webinar is that we do have these slides added to the handouts, so you can download them as a PDF if you'd like to either follow along or keep them for review later. Check out the handouts box and you'll be able to download those slides. The other thing is we are taking questions, so please feel free to type right into the question box if you have anything that pops up. We'd be happy to answer it as we go. Corey, I don't think I have control to change the slides, so I'm going to just get started. And if you would just send control over when you have a minute.
You're right. Thank you. I'll handle that right now.
Thanks, Corey. So self-directed plans, we always like to go over the types of plans that are allowed because for whatever reason, oftentimes people will say to us, well, I don't have a Roth IRA, so I can't invest in real estate. And the truth is, if it ends in IRA, it can be self-directed. So traditional is, of course, the most common type of account that we see. That's probably because a lot of times people are rolling over from an old employer plan, Roth IRAs, and then employer-based IRAs like SEPs and Simples. We can help you with those. We can even establish them from the beginning with those for self-employed or sole proprietors, independent business owners. We can also help you with a solo 401k. Any former employer plan can be self-directed, and we always like to emphasize that because if you're currently with a W-2, for example, W-2 employee of an employer, and you're participating in their plan, you do have to check with them to see if the plan allows you to move some or all of the funds. We can also help you self-direct a health savings account or an education savings account. So all of these accounts can be self-directed, which means when we get to case studies that we're going to be talking about, you will be able to utilize those types of accounts for the investment that you're looking to make. Corey, slide.
Sorry, Larissa, I had myself muted. I did hit the button to give you keyboard and mouse control, but I'll go ahead and advance this one here now. We did have a question come in. How does the at-risk capital in commercial real estate investing work? I don't think that necessarily relates to that slide you just were covering, but how does the at-risk capital in commercial real estate investing work?
That I'm not really sure of that question, I'll be honest. So if you could just maybe further expand on that, unless Corey, you understand what they're asking you. I mean, certainly you can invest in commercial real estate, and you're going to determine the investment and the structure of it yourself. And so if you want to invest in commercial real estate, you certainly can do that. And then looking at the different ways to structure that deal are going to be up to you. And I don't know if that really answered the question.
Yeah, I'm not sure either, and I don't want to derail our actual intended topics and things today. My interpretation of that question would more so be, something to ask a syndicator as you're doing your due diligence on the project specifically, not, I guess, to the retirement account custodian. But I'm going to go ahead and remute myself. Larissa, you should have the keyboard and mouse control, and if not, just chime in again. I'll continue to advance the slides for you.
Okay, thanks. So just really briefly, just some things you should be aware of. The IRS does have rules for self-directed IRAs. Two asset classes you can't invest in are going to be life insurance and collectibles. Prohibited transactions would be transactions between the IRA holder and anybody up and down your lineal tree. Basically, all of that just to say that your investments should be at arm's length. They should be with non-disqualified third parties or people unrelated to you, essentially, and that you're making those investments for investment purposes. And you can always check out our video archive if you're looking for more information on that. And then there are some instances when an IRA is exposed to tax. That tax is known as unrelated business income tax. It applies when there is business activity in an IRA. And again, we're not going to make a determination on that, but we certainly could help you understand how it works. And then unrelated debt finance income tax does also, or income does trigger UBIT or unrelated business income tax as well. And that would be when you purchase a property and use financing to buy. So we're not going to talk about that today, but when you're buying real estate, you certainly can do it with a loan. And if you do, you will expose an IRA to this additional tax called unrelated business income tax. Slide. So here's just a quick slide on who is a disqualified person, people that are not considered disqualified that are related to you, brothers, sisters, aunts, uncles, cousins, but we would caution you to work with those individuals at an arm's length or for investment purposes so that the transaction does not invite IRS scrutiny. And we go into that in further detail in other webinars. And again, you can always check it out or email myself or Corey and ask for a webinar that details those types of transactions so that you can understand it with more examples and things of that nature. Slide.
And Larissa, as I'm advancing to the first slide of the case study, I did notice someone did the hand raise feature, and I just wanted to let the audience know we will keep everyone muted for the duration of the webinar. So if you are intending to ask a question or raise your hand to input, please do so via the questions box. That is how we are fielding your questions today and keeping you as the live audience included in as part of the webinar today.
Great, thank you, Corey. And we're going to start now with a case study. And what Corey and I have done here is we set up two case studies. We're going to be talking about these investments separately, so as separate investments of the retirement account. And then we're going to talk about how we have seen clients combine or really sort of morph one investment to another in order to obtain the goals that they have for themselves and for their retirement account. So first case study is going to be on buying real estate. The second one is going to be on private lending. And then in our final case study, we're going to talk about how we have seen clients buy real estate and then sell that real estate and hold back a note in order to change the relationship that they have with the buyer from that of, maybe a tenant to somebody who is borrowing money in order to make a purchase of that piece of real estate. So case study one, purchasing real estate in an IRA. Slide. John in this example has an old 401k that he wants to use to buy real estate. And so we're going to really simply outline who does what here. John is going to open and fund his IRA account. We're going to assist him with that. So when John tells us, hey, my 401k is with an old employer, I want to move it over, we're going to say, okay, John, that's going to be considered very simply a rollover. We have you complete a form on our end after your account is open, and then you're going to go to the old employer plan and fill out some forms with them in order to initiate the rollover process. In the meantime, while we're waiting on funds, John can be looking or scouting for that piece of property he wants to buy. Once he finds it, he's going to make all of the paperwork, everything from contract to close in the name of the IRA, and we're going to assist him. So John will reach out to Advanta, say, I found a property, I'd like to make an offer. My real estate agent is working with me to write that offer. We're going to work with the real estate agent or with John directly to give him the information to show the IRA as the buyer. Advanta IRA for benefit of John Smith IRA number 1234 would be the buyer. And we are actually the legal signers for his IRA. So very important, John will give us the offer. We will have him approve it. So we're going to have him sign it, letting us know that he reviewed it and that is the offer he wants to make. And then we're going to sign on behalf of the IRA and submit it to the seller's agent. Once there are, everything agreed upon, then we'll go to close for John on behalf of the IRA. So we're going to work with the closing agent or closing attorney. We're going to sign all documents after we have John's approval for the closing, and then we'll treat it as a mail away, which is 100% of the time how I think we've seen one in-person closing here at Advanta since I've been here for 11 years. So they're always treated as a mail away. And then Advanta IRA is going to hold the deed and copies of all documents as part of our role in record keeping for John. Slide. So the investment strategy, John is going to rent the property for $1,200 a month for 2 years. And when he's ready to sell the property, he's going to let Advanta know and then work with his real estate agent, his closing attorney or title agent to get through this sale. And in this example, again, just a very simple, John bought a property and now he's selling it for cash. When it is rented, his tenant is going to pay that $1,200 a month either directly to the IRA or directly to the property manager. The property manager would then cut a check to the IRA, net the check or net the rent, whatever is agreed upon. And all of that income is going to go directly back to the IRA. So all of that to say that, again, when we talked about takeaway points or key points, that the IRA is going to receive any income directly related to that asset, and it's going to be responsible for 100% of the expenses as well. So if in that 2 years while the property is rented, the property needs a new toilet or it has some maintenance issues that come up that need to be addressed, then John is going to work with Advanta to pay vendors for those expenses. It's very important that John does not write a check to a vendor personally, and that goes back to those prohibited transaction rules. So that's very important. When John is ready to sell, again, he's going to get in touch with us and with his agent and the closing attorney or title company to work with all of us involved in that transaction to sell the property. And then once the property is sold, the funds are going to go directly back to Advanta no taxes are paid, and the total profit on this investment was 78,000. And I always like to say the numbers really aren't important here. What we're trying to illustrate to you or demonstrate to you is the process involved for making this investment. It's important to note that there is no requirement that John holds this property for a year and a day because capital gains do not apply to an IRA account. And there's no requirement that once the money goes back to the account from the investment, that John holds it at Advanta for any amount of time. So if in the meantime, he's found another property, he's going to lend money, he wants to buy precious metals. Once the money hits his account, we can then turn it around for the next investment. So, all again is dictated by John, and he's going to let us know and just keep us informed so that we can help him with those investments as our role as a record keeper to make sure everything is titled properly. Slide.
And Larissa, real quick before you jump into managing the property, I did get a follow-up from that question earlier, so I want to do a quick callback. The question was, how does the at-risk capital and commercial real estate investing work? And after you and I discussed it briefly, the person that posed it said, the funds applied for earnest money deposit inspections, etc. It's applied and returned within 60 days. So we are familiar with the earnest money deposit process. That does need to come from the retirement account when you're planning to make the investment in the name of the retirement account. And if the earnest money deposit is defaulted, then that is money that your retirement account does risk losing. Now, you are in a gray area workaround type situation allowed to put up an earnest money deposit of personal cash if you're someone just getting your account started up and it's not funded yet with Advanta, so long as you overfund at closing with the retirement account and the closing agent is able to cut that earnest money deposit back to you personally. So that is for commercial or residential real estate. That's how the answer would apply. But it is subject to be paid directly from the retirement account if you're making the investment in the retirement account. And in a certain scenario, because there's a third party holder, meaning the closing agent or the title company, you can pay out of pocket for that so long as you overfund at closing so that out of pocket amount is returned to you directly and there's no actual commingling of your personal money with your retirement money. Having said that, I'm going to turn it back over to you, Larissa.
Thank you. So repairs and maintenance, who can't do the work? Well, the IRA holder and any of those persons that we said earlier were considered disqualified persons to work with the IRA. So if you have a son, for example, that is a property manager or does maintenance, you can't hire your son to do the work for your IRA owned property. That would be prohibited. Even if it was at fair market value, at market rates, whatever, that would still be considered prohibited. And so you want to work with, now the IRS doesn't say which vendors you can work with, they just say who you can't work with. And that's basically going to be people related to you up and down your lineal tree. So you can hire, the handyman down the street, the neighbor next door to mow the lawn. It's completely up to you, but just making sure that those persons are not considered disqualified. Even if you have a can of red paint, for example, even if you wanted to paint the front door, just run over there and paint it, that is still considered prohibited. And I recently had somebody say, why? What's the problem with me going over and doing some of the maintenance on my IRA owned properties for my retirement? And the way the IRS phrases it is that they do not allow any non cash contributions to the IRA. And so, therefore, doing any sweat equity on an IRA owned property would be considered a non cash contribution to the account, which would then be prohibited. So, just keeping that in mind. Slide. Expenses, again, are paid by the IRA, and that's everything from earnest money, as Corey mentioned, all the way through to closing costs. So sometimes people say, well, the property is 120,000, I have exactly 120,000, how do I pay the closing costs? Well, if the IRA is going to own the property 100%, it is responsible for the closing costs. So can you make an annual contribution? Can you move more money from another retirement account? Or maybe bring in a partner on this deal where you partner from the outset of the investment in order to make it work. You can also take a loan in order to buy the property. It does have to be non-recourse, and it does expose the IRA to that tax we talked about earlier. And you can find all of that information on our webinars on private lending and borrowing. A property manager certainly can collect the rents for you and pay expenses, and they're going to net out a check maybe monthly or quarterly to the IRA account. And your agreement with your property manager is your own. Again, just keeping in mind that the property manager cannot be someone related to you up and down your lineal tree. Slide.
All right, and at this slide, I will be taking back over to jump into the private lending side. Thank you, Larissa, for covering the real estate investment side and the ins and outs of owning real estate in a retirement account. But we're going to transition a little bit here and talk about types of private lending you can do within your retirement account. So the traditional mortgage, either a 15 or a 30-year loan, 5-to-1 ARM or balloon note can also be held. Short-term transactional funding, so bridge lending, can be done through a retirement account. Unsecured promissory notes, so just a physical piece of paper that has terms on it and signed by the borrower. We've processed plenty of those in our days as client account managers. Equity participation or joint ventures, so maybe you've got a partner that has a piece of property or just a piece of raw land, and you've got money to develop that property. You can set a joint venture agreement up, and I've definitely helped process those as well, breaking maybe a single property into multiple parcels and generating multiple real estate sales after a parcel has been sold and other additional ones are being acted upon. And then even secured notes, secured by asset classes outside of physical real estate, like farm equipment, automobiles, livestock. Now, keep in mind, an automobile is an asset class that is not allowed to be held in your retirement account, as we went over earlier in the prohibited rules and regulations. So if you are setting up a security instrument that involves a asset that is not specifically able to be held in your retirement account, you do have some restrictions and regulations as to claiming upon that security instrument and then immediately making efforts valid or commensurate with the IRS's rules to go ahead and sell and remove that asset out of your account as efficiently and quickly as possible. It is allowed to be done, but again, keep in mind if you're considering that route, that there will be some extenuating circumstances. And again, your client account manager with Advanta IRA is going to be here to answer those questions, make sure you're aware of those scenarios, and help guide you through that process if that's an asset class that you're claiming as a security instrument on a defaulted loan. Now, establishing the note terms. Everything listed here is completely up to you as the account holder and as the lender. So you choose the amount you're willing to lend out. You set the interest rate negotiating with the borrower. You choose the length of the loan, any equity participation terms, and the payment due date and delivery address. So we are not a loan servicer. We allow you to either have the loan paid directly to Advanta, and we will have a statement generated and you'll get an email notification when that deposit hits the account with Advanta. But aside from that, if you want actual loan servicing, meaning someone assessing a late fee to your borrower if they don't pay in a timely manner or by a designated date, then you may want to consider yourself to be the delivery address where you receive the payment and forward that payment directly payable to your Advanta account along to us, or have a third-party loan servicer put in place that we will coordinate and work with directly in that case scenario. So including those provisions in your lending agreement is definitely part of your responsibility as the account holder and part of your due diligence as you're going into a lending strategy through your retirement account. So the benefits of private lending is you get to act as the bank and determine all the terms as I just referenced. You set the rate at which your IRA will grow. So you have a designated rate set on this note agreement and you're not worried about what the market fluctuation is. So you may be receiving 3% this month and have a downturn in 4 or 5% less than you had last month or last quarter. You actually set the terms, and as long as your borrower is paying on the note, you know exactly what those terms are. And if they're not paying, that's when you start leaning towards collecting on the security if you have one in place. If it's just a promissory note and an unsecured loan, well, then you probably want to have a conversation and start working with that borrower for modifying the loan agreement, which is also allowed to be done. It's completely your discretion. There's less liability than owning real estate directly in the IRA when you have a loan in place, and oftentimes you have a security instrument you can claim upon if the borrower is defaulting against the loan. You can have very low maintenance assets in the account, so just mailbox money, for lack of better context. If some of you are familiar with the term mailbox money, you've got your money working for you. You don't really have to do too much besides setting those terms and setting the agreement with your borrower and vetting your borrower, obviously, as well, to know that you trust them and believe that they will pay and do well on the note. And partnering funds with other IRAs or individuals can be done. So if you connect with someone looking to borrow money, and let's just say they're looking to borrow 100,000 and your retirement account has 30,000, you might know another retirement account investor or even another friend, or consider yourself personally, that can be co-lenders on a note. Each lender will have to be listed on the note commensurate with the amount they're putting up to lend, but it can be done where you're listing multiple lenders and you're actually partnering together with either more individuals, more retirement accounts, or a mixture of both to generate a larger note and a larger investment opportunity. Now, my case study that I'm going to cover here is holding a first position mortgage, and we're going to jump right into that here with a case study individual named Paul, who has 120,000 in an IRA and wants more consistent terms than the traditional stocks, bonds, and mutual funds he had been investing into. He meets with a private mortgage broker who can place his funds into a first mortgage with a qualified borrower. Paul does his due diligence and vets the property and the borrower and agrees to the terms of $120,000 loan at an 8% interest rate with a 5-year balloon, monthly payments of $800. And again, that is secured by a first mortgage on a piece of property. So moving forward with this investment, Paul has his Advanta IRA account. The loan and terms he just agreed to on the last slide are put into place. He makes the offer to lend on his terms, informs Advanta, basically just reaches out to his client account manager to get the process started, provides the loan documents, so the note, the mortgage, and in Advanta's case, just 2 simple purchase investment documents to direct us to fund the transaction on his behalf. He marks everything as read and approved, meaning he's authorized us to execute the transaction on behalf of his retirement account. And then the client account manager on Advanta's end will review all of those documents to make sure they're in good standing and all properly worded. We get Paul's approval. We process the transaction to wire the money to the closing agent. We make sure we receive back a copy of the recorded deed, the original note, and the mortgage in place, and the investment is completed. Now, after this investment closes, the borrower sends the monthly interest-only payments directly to Advanta IRA. They're deposited into Paul's retirement account. He gets an email notification or can always check using his online portal. And the borrower decides 3 years later that they want to sell the house and pay off early ahead of that 5-year balloon note that we referenced earlier on. So in this case, there's no early payment penalty or anything stopping the borrower from doing that. So Paul IRA makes $28,800 of interest payments, return on capital, return of capital, as well of the $120,000 at sale. And Paul's interest will pay no capital gains tax on the accrued interest through that investment strategy. So again, the $120,000 was lent out expecting to be out in place for 5 years. During the first 3 years, it generated $28,800, and then he received back not only that amount, but also his initial $120,000 investment placed, so that he can move forward and invest it in other assets or other properties or loans as he sees fit. Now, when you're doing seller financing through your retirement account, you always want to know some of the basic terms. So money mortgage is a common synonym for seller financing. A money mortgage loan, meaning your money is actually being used to mortgage the property that you're selling. The IRA owner determines the rates and the terms. And again, this is the seller of the property in this context as well. You're owning the property that you're selling, and you're able to go ahead and dictate the terms, not only of the real estate sale, but also of the loan that you're being the lender on. It's even more passive if you decide to move away from owning real estate. Again, as Larissa covered, You may have some maintenance on a piece of real estate. There may be deferred maintenance if you're buying an older piece of property, and you can kind of get out from some of that if you just sell the property and take back a loan instead against the property. Be aware of laws that may impact this investment. There are specific laws that may come into place depending on what state you're buying the property in or what jurisdiction. You can even do a strategy like this internationally. So some of those types of rules and regulations, again, we are key experts in what the IRS will or will not allow, but there may be some other laws and regulations that you'll want to be aware of or make yourself aware of as you go into these types of strategies. And again, consider how the payments are collected. Do you want a third-party loan servicer in place, or do you want to have the funds sent directly to Advanta IRA? Do you want to serve as your third-party loan servicer to not have to pay a flat rate or a percentage on the investment in itself? Those are all things to consider, and just make sure you're aware of as you're setting up this type of investment strategy. And with that, I will turn it back over to Larissa.
Thank you so much, Corey. So we're going to talk, we're going to take each of those points and define them for you to get a little more specific and help you understand. So seller financing defined, it's an agreement between a buyer and a seller for the purchase of a property on payments over time. So the seller very simply agrees with the buyer that they are going to maybe take a down payment, maybe not. They're going to set the rate. So maybe it's based on what they want monthly from the buyer. So they might say, well, I want $1,200 a month. What does that work out to? Or they may say, I'm looking for 10% on my money in this loan and 3 points or whatever it might be. So again, the seller financing is agreement between the buyer and the seller for the purchase of a property based on payments over time. It's also sometimes referred to on the buyer's side as a purchase money mortgage, so or an installment sale on the seller side. So if I was the buyer, I may consider this a purchase money mortgage because I'm buying it with a mortgage that is being created by the seller, or again, an installment sale. So if I am selling the property, I may sell it on payments over time or in installments. The terms and rate are agreed upon by both parties and can be paid in a traditional style with amortization over 30 years. But there are so many strategies that are linked to loans in general, and then of course seller financing, that it is completely up to the buyer and seller, or the individual lending the money. So in this, here we're talking about a buyer and a seller, but we can also be talking very simply about someone who lends money in the form of private mortgages. Slide.
And Larissa, before we jump into the next slide, there's two questions if you'd like to go over them with me real quick.
Absolutely.
Sure. So the first one is, what are the exit strategy for notes of property? I think, and I would love for you to add your input, I think the exit strategy really depends on what you set forth in the terms of the note. If you want to set a balloon note after a certain time period, if you want to have an early call penalty, if the borrower decides that they want to pay off the note earlier, those are all just general note terms that you as the account holder have the discretion to set as you see fit. Larissa, do you know any extenuating circumstances or specific terms that can or cannot apply in these scenarios?
Yeah, absolutely. The one that really comes to mind is very simply that if you have a note and you're receiving regular payments, but for whatever reason, all of a sudden you decide you no longer want to hold a note or cash out of the investment, so to speak, what would you do with that? Well, certainly there are people who will buy notes from other individuals. There are investors out there that have made it their business strategy to buy notes. And so if you said, I just want out of this investment, I would like to liquidate it as quickly as possible for whatever reason, you certainly could find third parties who would buy a note from you. And it doesn't have to be an individual. I believe there are absolutely companies out there that will buy notes as well. But certainly one of your exit strategies could just simply be to sell it. Another thing is talking to the borrower and saying, you know what, I agreed that the term of this would be 5 years, but for whatever reason, I now would like to liquidate this and have you pay me back in full and work it out with the borrower. And many times we have seen the borrower simply say, okay, I can refinance this through another type of mortgage or a traditional type of mortgage, possibly, or with another private money lender. And so there are those options as well. There might be another circumstance where maybe the seller and therefore note holder says, well, you know what? I don't want to be involved in this property anymore, and I'd like to see some maybe different collateral on it. And so you may agree with some investor that you're going to move the mortgage to another piece of real estate. And so we've seen all of these strategies used, and that might be something to consider when you're looking at exit strategies. But do keep in mind that typically a note is not going to be an asset that is liquidated very quickly. So it really just depends on where you're looking to move that note, whether it just be simply liquidation and selling it, or working with your borrower to get it paid back quickly.
And just a quick shameless plug to our biweekly Friday event, Pitch, Promote, Prosper. If you're someone that has an asset that you may want to offload either through your retirement account or elsewhere, we do have a network every other Friday called Pitch, Promote, Prosper. It's a Zoom call, 12 Eastern to 1 p.m. And some of these asset classes that are being moved around, as Larissa mentioned, there are investors on that call that may be interested in purchasing that asset from you, whether it be as a direct investment or through their own retirement account that they have. So that is a network that we offer. Again, same disclaimer as today, we don't do any due diligence. If you find someone that may work with you on a deal, conduct your due diligence and make sure you're comfortable with that. But it is an opportunity for you to find someone that may fit a need to offload an asset that you're no longer interested in holding. And the next question that we had brought up, what happens to those funds? I think he was referring to my case study that I just covered with Paul. What happens to those funds if he doesn't have another deal in the sidelines to move it into? Well, once we receive any amount of cash back into the retirement account, it is in your account as what's known as undirected funds. Again, as I referenced at the top of the webinar, that is funds that are sitting in your account, insured up to FDIC limits, but they are not earning any interest or growing for you until you place them into your next investment. So there are plenty of different strategies based on someone's risk tolerance that they could choose. You know, you could have a brokerage account in the name of your Advanta IRA account that you move some money into. You could let it sit idle until you find your next large deal, or you could move it to another type of asset class. But ultimately, it does sit undirected until you make, as the self-direct account holder, a direction of those funds. And then the final, I guess, the person that asked about the exit strategy question, Larissa, that person also said, with the backlog in courts, what are legal options for default? I think some of that really goes to a specific jurisdiction and really dealing with a legal professional. But I mean, depending on if the asset is secured or unsecured, you may be subject to dealing with that backlog in the courts versus an unsecured note where there's really no recourse to be had. Do you have any input to that effect as well?
Yeah, I still always suggest speaking with your attorney on that, but actually it will depend also on what state you're in. So for example, in the state of Florida, we are a mortgage state. And so the lien is in the form of a mortgage, whereas, you know, differently than as Georgia is as security deeds or deed of trust state. And so their process for foreclosure is going to be much different than our process. And so knowing your state laws, as Corey alluded to earlier in the webinar, is going to be very important here, because you are going to very likely be working with an attorney for your IRA's purposes for that foreclosure, and it'll be important for you to know what that process is going to look like.
Awesome. That covers the questions that we've got in the box right now. Please keep them coming. Thank you, everyone, for participating with us live. Larissa, I'm going to advance your slide now, and we will keep going.
Okay, great. Thanks, Corey. So the IRA owner determines the rate and terms, and I think we really sort of drove this home many times in this webinar that it is completely up to you as the IRA holder what terms you are comfortable with for one, or what you're going to agree to. And so, for example, if you're only comfortable with a first mortgage, so you want to be in first lien position on a property when you lend money, then that's completely up to you. We do have people who lend money in the form of second mortgages, third mortgages, and even unsecured. And so, you know, you're going to look at your risk tolerance for something like this and make a determination at what your terms are and what is agreeable for you as the IRA holder. The IRS doesn't have any requirement that, you know, a loan is paid back monthly or quarterly. It could be a single payment note if that is something that you're comfortable with. Slide. So again, even more passive if you decide to move away from owning real estate. Many people get tired of tenants, toilets, and termites, and especially don't want to deal with it in their IRA account. And so they may say, you know what, I'd rather look to private money lending. Remember, we talked about how there's less liability than owning real estate when you have when you're the lender. So looking at, for example, your own mortgage company. So if you own your own home and you have a mortgage in place, and somebody came to your house and there was a slip and fall, would they contact your mortgage company, or would they be talking to you about the slip and fall? And so looking at something like that. And then also looking at simply receiving payments rather than worrying about any upkeep on the property. So again, your mortgage company for your personal residence is not responsible for any upkeep on that property. It is completely up to you as the IRA, or excuse me, as the homeowner. And so if the IRA owns property, it is going to be responsible for the upkeep. Whereas if your IRA has a loan in it, somebody is paying mortgage payments to the IRA, and therefore the IRA holder is not responsible for that upkeep. Slide. Again, Corey talked a little bit about this, being aware of the laws that may impact this investment. So when you're working with someone who is referred to as an end user or retail buyer, or essentially somebody who is going to buy the property and live in it, you should work with an attorney to understand what might be required of you as the lender. So think about something like Dodd-Frank, for example, and other consumer protection laws. So they are out there, they do exist. And so what do you need to know based on those laws, not only federally, but maybe locally as well, to make sure that you're in compliance with anything that would apply to those types of laws. And so we are not consultants for this. We can direct you to attorneys that may be able to answer your questions, but understanding if you need to maybe have a loan originator, for example, in order to adhere to certain terms of loans and requirements in qualifying your borrower before going forward with that loan. Slide. How are payments being collected? So is your borrower sending their payments directly to Advanta, but keeping in mind Advanta IRA is not a loan servicer, so we don't monitor when payments are received. And I think that is one of the questions that we get from time to time, where somebody will say, especially over, especially the month of December, where we have a lot of holidays coming up and also a little bit behind us as well. When was this payment received? The best that we can tell you is it will be deposited for you on the next business day. But for example, we're not here on Saturdays. And so if there's a federal holiday being observed that following Monday, well, then the best that Saturday or Friday's mail is going to see is deposit on Tuesday. And so we don't know if it was received on Friday or Saturday, or maybe even in Tuesday's mail. And so that's very important to understand, so that if you're looking for those payments to be received, by the 1st or by the 5th of every month, that we're not check marking and dating those checks. We're just receiving them and depositing them on the very next business day. So consider hiring a loan servicer if you're looking at that type of specific record for your accounting. The other thing too is you can always ask the borrower to send the payment directly to you, but it must be made payable to the IRA. You cannot accept constructive receipt of those funds. So the check would be paid to the IRA, but when you receive it, you can check mark it in your ledger and then forward that check on to Advanta. But again, we're not a loan servicer. So if you're looking at something like that, then you would maybe look to a loan servicer to assist you with that. And again, consulting an attorney if you're working with a consumer or retail buyer, or basically somebody who is buying to live in the property. Slide.
All right, Larissa, we are going to bring it home with all of the information we've just brought up. Your first case study, my first case study, merged together into case study number 3, selling an IRA-owned property with seller financing. I'll go ahead and cover the first half. Larissa's going to cover the second half. Then we'll take any final questions that you guys have from today's webinar, and we'll go ahead and get you guys out of here. We try to keep these webinars right about to an hour to be mindful of everyone's time. So we're going to finish it out here by applying everything that we've just discussed with you into a final case study. So we are going to start here with Mike, who has an old 401k worth $160,000, and he finds a house worth $150,000 that doesn't need much repair work. He opens and funds a new self-directed account, does a rollover from his previous employer 401k that is not a taxable event. It does not generate any taxable liability to get that money moved over from that old 401k plan to the self-directed IRA. and then he makes that real estate purchase, just like Larissa went over in the first case study. He makes the offer in the name of the IRA. It's executed by Advanta IRA as the administrator after collecting Mike's read and approval on all of the documents for the closing table. We do a mail away closing transaction, wire the funds to the closing agent, and actually receive the ownership record in the name of Mike's IRA account. All of the rent while he's owning that property is paid directly into the IRA account. Any expenses that he needs to pay are taken out of that IRA account. And again, he opened the account with 160,000. So even if there was a little bit of repair work before the property starts generating income, he's got about a $10,000 cushion to work with to pay some expenses until that property starts generating some income that he can build off of and pay additional expenses off of. So the paperwork is written in the contract, in the deed of title in the county in question is in the name of Advanta IRA for the benefit of Michael A. Aaron, IRA number 1234. The record for the address is Advanta IRA's main office address. So nothing should be tying through to Mike personally or his personal social security number for tax purposes. It all ties through Advanta's trust tax ID and Advanta IRA as the custodian administrator of the asset. Mike is going to determine what work needs to be done and when he's ready to rent the property, what strategy he will rent it at, whether it's short-term rental, long-term rental. Airbnb is an asset class that people are getting into, but so is long-term renting to a 1 or 2 year term borrower or lender. So Mike puts a tenant in the property and instructs the tenant to mail rent to Advanta IRA directly with checks made payable using the vesting above, not to Mike directly. And that again helps assure that the funds come directly into the account, keep the tax shelter benefit. And at some point, Mike decides he does not want to own the property anymore and would rather switch over to renting it out or leasing it over to someone else that's going to maintain the property and utilize it as an investment property moving forward. And with that, the terms here are that Mike has the property and finds an investor that's not going to live in it, but actually generate a master lease and take over the property and actually rent it out themselves. He just doesn't want to deal with the tenant rental agreements anymore, and he wants to kind of offload that property. Decided it's a strategy he doesn't want to be involved in any further. So the investor is currently managing the property, and this way it allows Mike to sell the property to him without going into some of those Dodd-Frank regulations that Larissa mentioned a few slides ago. Mike agrees to sell the property with seller financing in order to continue to receive income from the original investment. And the terms of the transaction are that he decides a loan amount of $120,000 is going to be borrowed against Mike's IRA account. The interest rate's going to be 8%. There's a 5-year balloon, and there's also an $80,000 down payment. So the real estate sale transaction is really a $200,000 real estate sale for Mike's initial real estate purchase of $150,000. He's only getting $80,000 at the transaction, but he does carry back a loan and a first position mortgage valued at $120,000. And right here, we're going to switch over for Larissa to finish the lending side of the case study 3.
Great, thank you, Corey. And guys, remember again that it's really the numbers aren't important here. The idea is the strategy. So he had somebody renting the property from him or leasing or sandwich leasing the property from him. Basically, he said, to the tenant, hey, I don't want to be responsible for the tenant. I don't want to be responsible for hiring vendors. So an investor came in and said, okay, well, I'll lease it from you, and then I'll turn around and lease it to somebody who wants to live in the property. That's a sandwich lease or master leasing. And so
hey, Larissa.
Yes.
I'm sorry,
yep.
your audio it sounded like a little bit distant, so I just wanted to not to cut you off. It's much better there. I just heard you say okay.
Thank you. Yep, thanks for letting me know. So basically say that Mike wanted to deal with another investor that was basically going to handle the property management in this unique way. He's using a lease to handle property management. Well, that investor wanted to buy the property from him and continue to lease the property to third parties, and so they come to an agreement on buying the investor buying the property from Mike. So he's going to do seller financing. Again, the numbers aren't important. Remember, you guys determine all of the financing terms. And so if you don't require a down payment, if your down payment is less, if you're going to go with a more typical or more traditional mortgage model where it's a 30-year amortized loan, but you're only expecting 15 or 20% down, that is completely up to you. But the idea being that Mike determined what he wanted down and what rate he wanted for his IRA monthly in the form of monthly payments. He's going to work with Advanta IRA. And remember, there's two pieces here. He's selling the property, so there's the paperwork for selling the property, and then he is also investing in a loan. And so even though we're saying that he is getting an installment payments to the IRA based on the sale, or that it's a seller financing deal, there's still two components to this deal. So Mike is going to fill out sale authorization forms with Advanta, letting us know that he's selling the property. He's going to fill out purchase authorization forms with Advanta, letting us know he's investing into a note. And then we have to work with the title agent or closing attorney for all of these aspects of this deal. So once all of the documents go to the title company, we're going to make sure that everything, the sale documents, the investment documents, the lending documents, are all in the name of the IRA. We're going to have Mike read and approve everything. And then once that's done, we'll work with the title agent or closing attorney to sell the property and then to hold the note in return. Slide. The borrower will send the monthly payments to Advanta, or maybe Mike again determines that he wants to use a loan servicing company, or that he wants to receive the payment directly to himself and then made out to the IRA. Whatever it is, Mike's going to let us know. And then once we receive the money, we're going to deposit to the IRA as interest income to the IRA account. And Mike can track that on his online account or through use of email notifications. Slide. And Corey, I believe you are going to close out the webinar for us.
Yeah, I'm sorry. I started speaking and had my mute button on.
No problem.
That brings us to our takeaway points. Again, as I promised you at the top of the webinar that I would share with you again to make sure everyone does have these and that we hit home with these. So takeaway point number one, you can create multiple investments with one asset. Let's look at the examples from today: owning a piece of real estate and then selling that asset and being the lender on that sale transaction. And as we went over, it does not have to be a piece of real estate. There are a number of other asset classes you can hold in your retirement account, decide to sell, and be the lender on that sale transaction if the borrower is not able to or chooses not to buy that asset from your retirement account outright. As the seller and also as the lender, you dictate all of the terms involved in this deal. As Larissa mentioned a few times, the numbers we gave you were for example purposes. You set all of those terms yourself. It does not have to be any certain percentage. It does not have to be any certain dollar amount, any certain down payment. You set those terms completely. As long as the IRS sees that there's an actual investment to be gained and that you're not just giving a deal away to someone that is a non-disqualified relative or friend or someone like that, you're allowed to do those types of transactions to gain and to create passive income in your retirement account. And the final takeaway point is that the IRA pays all of the expenses and receives all of the income related to the asset, both the real estate asset or the initial root asset and the lending asset component when you're deciding to move on from the actual asset and take back a loan, whether it's a secured loan, a mortgage, or any other type of unsecured loan on the back end of that transaction. Now, we here at Advanta do our best to bring you a lot of educational content. You can check us out if you're in the Tampa area, in the Atlanta area, or in Western North Carolina, or even some parts of Eastern Tennessee. I am located in Western North Carolina. I do a lot of networking and traveling. So the events that we put on locally, check us out. You can go to advantaira.com and look at our events tab. You'll see all of our upcoming webinars as well and different different content that we've got going on. We have a video library. This recording in itself will be on our YouTube channel. You can go to advantaira.com and check that out, or go to YouTube/AdvantaIRA to check out our robust library of different topics, different guest speakers, different things that we've covered. And if you're interested in industry specific information and news, you can go check out our blog on our website as well. That gets into more of the specific industry news. About a year or 2 years ago, when some of the legislation was in place that affected our industry, we were at the cutting edge of change.org petition, and making sure that our industry and your ability to self-direct your retirement funds were not impacted. And luckily, we were able to get that details removed from the pending legislation at the time. So if you're interested in protecting these rights and these rules, please follow us on our blog and our other social channels. We will go ahead and flip here to the presenter slide as we just look real quick and see there were a few final questions.
Yeah, there are some questions, Corey. We had one, somebody asked if a self-directed IRA can be passed on to an heir. Absolutely. When you open your account, you are going to designate your beneficiaries. You get primary and contingent beneficiaries, and you would list them out for us so that if something should happen to you, we know who your heirs are so that we can assist them in the inheritance process.
And just to add to that, you can list a trust or an estate as a beneficiary if you've already got something like that in place. It does not have to be an actual individual person. Depending on if you're living in a community property state or not, you may have to have your spouse sign off if your spouse is not your primary beneficiary. But we do allow you, and actually we make sure that you list a beneficiary as you're going through the onboarding process to set up your account.
Exactly right. Somebody did also ask about the recording. The recording will actually be emailed to you. So you'll be able to find it on YouTube. So it'll be posted in just about a day, but it will also be emailed to you. So anybody that signs up for our webinars, we make sure that the recording goes out to them for review or sharing or whatever makes you sort of helps you along with this process.
And also, don't forget, as Larissa mentioned at the top, sorry, I didn't mean to cut you off, Larissa. We did post a PDF handout of the slide deck today in this GoToWebinar platform. So if you go to your GoToWebinar box, there should be a tab labeled handouts. There's one attachment there. It should say 1 of 5, and that is a PDF broken out of our slide deck. Also, if you wanted that PDF slide deck, you can reach out to Larissa or I via email, and we will be very happy to share that with you.
Yep, absolutely. And then another question was, what happens if after you purchase a property, there are unexpected expenses that correspond with the property, and what happens if it goes beyond the remaining account balance? So that's a great question. And remember, we talked a little bit about it where we said, okay, could you make an annual contribution? Because this is an IRA just like any other. So if you're eligible, you can always contribute to the account. Your contribution is going to be limited to the amount based on the account that you hold. So a traditional or Roth IRA would be $6,000 or $7,000 each year. You can always transfer money from another retirement account. You can look to borrow. So although IRAs don't often borrow, they can borrow. You just want to make sure that if your IRA borrows money, it is in the form of a non-recourse loan, and that you are aware of the unrelated business income tax that it will incur for doing that borrowing. You can bring in an unrelated partner. So after you purchase the property, it's too late to bring in anybody that would be considered related to you, or a spouse's IRA, for example, or a child's IRA. But if you wanted to bring an unrelated third party in as a partner, you could sell a portion of that property to an unrelated third party or their IRA account in order to make that investment work.
And I believe that question in itself, the same person posted a corrected version. What if Mike purchases the home and after he closes, there's unexpected expense beyond the? Oh, it was the same question. So you did just answer that. The only thing I would add to that answer and to that question is from the account management standpoint. That is something I know that our account management team is aware of and does try to help you with. If they notice you're someone like Mike that opens an account and funds an account with $160,000, we'll typically give you a heed of warning if we see you looking to close on a piece of real estate valued at $157,000 or something like that. Just by having that conversation and providing some of that guidance from our standpoint, just to make sure you, or in this scenario, Mike, is aware, hey, if you think there's going to be an upcoming expense, make sure you've got some other money as a safety cushion available, even if not money coming in right now, as Larissa mentioned, by any of those sources that you can move it in, so that you're not stuck in a position where, hey, I need a $10,000 roof and I only have $2,000 in my IRA account and I don't have any of these resources to pool extra money. You may very well be stuck just letting that roof, for lack of better context, deteriorate or get worse until you have the option and ability to handle one of those strategies to bring more money in. So from an account management standpoint, we help you strategize like that. And again, we're not providing tax advice or legal advice, but we're trying to make sure you're aware and have foresight into whatever may be around the next corner.
Great. Thank you so much, Corey. And I don't think we have any other questions. So with that, we would like to thank everybody for joining us today. We hope that you will review the recording and reach out to us with any questions. We also hope to see you on some future webinars and also our Pitch, Promote, and Prosper sessions. We do not have one this Friday, but it will be the following Friday. And then, of course, our schedule for Pitch, Promote, and Prosper will vary a little bit with the upcoming holidays. So please check out our calendar of events for further information on that. Thank you so much, Corey.
Yeah, thank you very much, Larissa. I'm really happy to cover this topic with you. I know it's one that, as you mentioned at the top of the webinar, we've discussed thoroughly and kind of put the wheels in motion to get this content out to our audience here for a little while now. So it's great to finally get this on record, and obviously we'll be able to refer back to it and maybe revisit this topic again in the future when we get some feedback on what the audience liked, what they didn't like, what they may want to hear more about. So awesome. Thank you all for participating and for attending or for watching this recording. Hope you have a great rest of your day. And again, feel free to reach out to us if there's anything additional we can help you with.